going to stay with Finance News now, and we're joined in the studio by Suzanne Haddan. She's the Managing Director of BFG Financial Services. Always good to have you in the studio, Suzanne.
Thank you.
Now, the big story, of course, today, we've got the Prime Minister reconvening National Cabinet today, bringing it forward by 2 days. It kind of shows the urgency of this third wave of Omicron, of COVID-19. Now, the Prime Minister is reportedly supportive of extending the pandemic leave payments. This obviously is going to add to the national deficit, but is it necessary, do you think?
I would be surprised if it wasn't extended. I think it's a hard call when you compel people to be at home and not able to earn an income, and then don't provide some financial support if they don't have sick leave backing them up. Now, it's $450 if you're under 20 hours and it's $750 if you're over 20 hours. I think that'll be important also for business, because they will be concerned if workers are coming in and may have COVID, because that'll mean even more workers may end up off sick. So I think it needs to happen.
Yeah.
I'm sure many businesses would be feeling a little bit triggered about all of this talk of pandemic payments and a third wave and that sort of thing. But the circumstances are different this year compared to past years. I mean, many people are vaccinated, a majority of people are vaccinated, and we're in that phase of living with COVID.
We are in that phase of living with COVID, and many, including myself, would think that was necessary. But the COVID is affecting businesses so adversely, because while we have wonderful employment rates, we also have a shortage of workers, and we have increasing number of workers who are off by necessity because they're sick. And that's payments from employers who cover sick leave, but they're not getting the productivity to provide goods and services to the public. It's a big drain on business.
Suzanne, you mentioned there we've got good employment figures. Of course, that data came out a little earlier this week. Employment rate has dropped to about 3.5%. These are fresh 48-year lows. What's happening here?
Well, certainly what's happening is we just don't have enough workers for businesses. It's got to the point where there's one unemployed person for every one job, and naturally that's not going to be a perfect match, so you can't say everybody can fill those roles. And what's happening, the competition is fierce, so that will mean wages are likely to start to increase. But what other flow-on effects could that have? For example, on interest rates, they're likely to go up.
Yes, that's what I read, that there were many economists tipping that this would mean a rise in interest rates. How does that connect?
So what happens is inflation is likely to increase. The governor has already speculated we might hit 7%. And one of the jobs, the main job of the RBA, is to get inflation down. And their blunt tool is increasing interest rates. Most of us thought there would be an increase next month. There's even talk it might be 0.75% or even 1%, which is massive.
It's pretty sharp if that's going to be the case, quite a sharp rise. Now, we talk about rising interest rates. There's been a lot about, the talk about how this is going to affect mortgage holders as well. But it's great news for retirees, isn't it?
It is great news. Now, one of the things I want to emphasise for retirees, if you've got your money in a term deposit coming up for reinvestment, if you're doing 12 months and it hasn't got a 3% starting, you need to look elsewhere. I was horrified. I was on one of the major banks' websites and they were offering as low as 0.15% for a term deposit.
Right.
Competitors, I can get 3.25%. So my tip there is shop around. Other thing for retirees, sometimes pensioners can get a bit nervous how it might affect their age pension. Remember, the government uses deeming rates. They assume what you're going to earn, up to 2.25%. Get 3.25%. That's extra money in your pocket without affecting your pension.
Yeah.
And speaking of people who might be cashing in on their superannuation, we've got many factors that would be impacting superannuation at the moment. Rising interest rates, even the war in Ukraine, market volatility, the high global inflation. I mean, Australia's not the only one dealing with high inflation.
Oh, we're certainly not. Look at US at over 9%. One of the disturbing things I think will be to particularly people in retirement who may be more conservatively invested, they might be shocked that they have a negative return on their super last year. And that's because of a very confusing thing. It's around government bonds and corporate bonds, which we all consider the safe investing. When interest rates go up, the value of the majority of bonds goes down. And so that means those safe options could have lost more money last year than the risky shares and property options. My tip there is hold your nerve, stick to your strategy. If you haven't got a strategy, you need to go and get one. Retirees should be holding cash, term deposits to cover a few years of their living expenses. The aim of the game is never having to sell at a bad time. That's what you aim for.
Good advice. Suzanne Haddan, always great to see you.
Thank you.